Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing a prolific author in the gold and silver space, none other than John Rubino of John Rubino's Substack. How you doing today, John?
Hey, Darrell. It's good to meet you.
Yes, you too, as well. Have some mutual friends in the space, so it's always good to connect and share stories and whatnot. Curious as we get started today, what are some of the macro views that you hold on the economy within the U.S. and also just curious in how the metals play into that?
Well, this is a wild time for the overall economy. We just finished, hopefully we just finished a war in the Middle East that had disrupted the energy and agricultural supply chains all around the world. And we're still going to see the effects of that. And at the same time, we've got this massive tech bubble going on with AI and space-related stocks just going through the roof. SpaceX just did the biggest IPO of all time. And while that's going on, we've got the U.S. government and most of the other governments of the world, large governments, running massive deficits, which is very stimulative in the short run, but inflationary and then deflationary in the long run. And we got a brand new Fed chairman who's having his very first meeting with the other Federal Reserve Board people now, as we speak. So all of that stuff is happening at the same time. And, anybody who tells you they know what GDP growth is going to be in the next 6 months is just delusional, because there's just too much going on for us to really know, exactly what happens with the economy in the intermediate term. Longer term, we're still in the same place we've been for the last 20 years. We're racking up massive debts. We're creating huge amounts of new currency to finance those debts. And we're, headed headlong for some kind of a currency reset in the not too distant future. So intermediate term, who knows? Longer term, we definitely know.
Okay, got it. So Kevin Warsh comes in, new voice, new, leadership, and he has his thoughts on how, we can reduce interest rates and keep inflation low and all of that. But, at the same time, the market has been kind of responding, wondering if the Fed's going to be hawkish moving forward. He is only like one of, I don't know if it's 12 voices or 12 votes on the board or whatnot. And then Jerome Powell decided to stay on the board, which was pretty uncommon from what I've heard. Typically, when a Fed chair is done, they typically step off to allow the new leadership to take place, but he decided to stay on. So curious in your thoughts on what can the Fed do in this situation? Do they have any tools left, or are they just there just to be performative and look good?
Well, they've kind of painted themselves into a box that it's going to be impossible to get out of, because the Fed has facilitated this massive increase in debt starting in the 1980s and then accelerating in the 90s and the 2000s and until now. And at some point, there's going to be a crisis that the Fed tries to address, as it always does, with much easier money. And it's going to turn out that doesn't work anymore, because there's so much debt out there that the bond markets just refuse to accept the idea that the Fed is going to dump another $5 trillion or whatever to bail out whoever. And it's not going to work. And then the financial markets are going to realize there is no more adult supervision in this market, and that we're basically on our own. And so we'll get something like the crack-up boom that the Austrian School of Economics talks about, where everybody just gives up on a currency, and they just, whenever they get any of that currency, they convert it into real stuff. The price of real stuff goes through the roof, which is basically raging inflation, and the currency basically just craters. So that's coming. And, I've been saying it was coming pretty soon for a long time now, and it hasn't hit yet. But we're heading that way fast based on the way all the numbers are built up. So I think something like that is coming. And at that point, the Fed won't be able to manage it. So the guys who are in charge of the Fed right now, their days of the masters of the financial universe are probably coming to an end. We just don't know when exactly.
Okay, got it. So crack up boom. When was the last time we had one of these types of booms? Was that in the 70s, where folks were, dumping the dollars for hard assets? Or
Yeah, the 1970s was a decade of currency crises, and there are a lot of things going on now that kind of that are reminiscent of what happened back then. But the difference is, in the 1970s, yes, we had an energy crisis, and then raging inflation, and then gold and silver went through the roof, and everybody was wondering if capitalism was the way we were going to go forward, or if we were going to have to become some kind of authoritating, or a version of the Soviet Union to get by, because what we were doing just wasn't working. But back then, we were able to raise interest rates to double-digit levels to fix inflation. We just squeezed inflation out of the market by making money incredibly expensive. And that bought us another few decades of basically debauchery in the financial realm. And this time around, we're facing some of the same problems, but we don't have double-digit interest rates as a tool to fix it, because in the 1970s, we had reasonably solid balance sheets pretty much everywhere, governments, individuals, and corporations. And here it's the opposite. Everybody's wildly over-indebted. So if we try to address rising inflation with much higher interest rates, will just blow up all the financial speculating community that's out there, which is mostly everybody now. So that's where we find out we don't have the tools anymore. When the Fed starts to try to raise interest rates, and even raises them just a little bit from where we are right now, and then all of a sudden, short-term interest rates, maybe they go up, but long-term interest rates go up much more, because the bond market just refuses to accept that higher short-term interest rates will fix what ails us now. And so, it's similar to the 1970s in a lot of ways, but very different in how it's going to end.
Mm-hmm. So what kind of happens with obviously you have the debt and deficits. The Fed has come in and reduced rates during COVID. We went, to the zero bound pretty much. Then they raised rates to a certain extent. I think it went to 4.5%, maybe 5%. And then they pretty much stopped, and then pretty much been pivoting ever since. And so obviously bondholders want to get paid a really good yield for the risk they're taking on, with inflation and how much dollars are being printed and so on and so forth. But we also have this dynamic where the government can't afford higher rates. And so what does that lead to?
Well, here's what's happened lately. Yeah, we did. We bailed out the global economy during the pandemic with massively lower interest rates. Something like 1/3 of the bonds that were trading in the world had negative interest rates for a stretch there. And that gave us 2022, when we had double-digit in official inflation in the U.S. We had a massive increase in the cost of living, which terrified everybody. And then we had to raise interest rates back to more or less normal levels, which is where we are now. But look what's happening to the interest costs on the government's debt. The government had taken on all of this debt over the past 30 or so years with gradually lower interest rates, which made the debt easy to manage, because the interest rates they had to pay on that debt were reasonably low. But now, rates are back to kind of normal levels, 4.5% on the 10-year Treasury. And the interest cost on U.S. government debt has rocketed up to about $1.6 trillion a year right now. So that's on top of the structural deficit that the government has to run to pay off Social Security and Medicare for the baby boomers that are retiring now. And that interest cost has to be borrowed, so that turbocharges future deficits. It makes them much bigger than they would have been otherwise. And so we're in kind of a death spiral now, where we can't cut interest rates, because that'll reignite inflation. But we can't let interest rates stay at the current level, because that's causing our interest costs to go parabolic, which is turbocharging deficits and making things much, much worse going forward. So we're in this place where there is no solution. And we just haven't figured it out yet. There will be a crisis. Something will have to be bailed out. And then the government will have to finance that bailout. And that's probably where we find out that we can't do that stuff anymore. And, there are a lot of potential catalysts for that kind of thing. In other words, sectors that could have some kind of a crisis that forces the government to bail them out. So it's just a question of what's going to be that catalyst. And we don't know that yet, but there's a lot of likely suspects.
Yeah. I imagine the AI sector is going to need bailouts in that type of scenario. Curious in your thoughts on the devaluation of the currency. So, obviously you have a big, huge print, from some sort of crisis that's going to devalue the currency. I'm still kind of perplexed why people may want to own bonds at this point when the dollar's being devalued so much. I mean, if you measure, anything in gold, whether that's the S&P, the Dow, the dollar, many different asset classes, you see that they're not making new highs in gold terms. They're actually, things are going lower. And so curious in your thoughts there.
Yeah, well, one of the things you don't want to own in a currency crisis is the kind of financial asset that depends for its value on the value of the dollar, right? So if you own bonds and they're paying you X number of dollars per year, and the dollar gets less valuable, then the income stream from those bonds becomes less valuable, and the bonds themselves go down in price. That's the kind of thing that we're looking at now. And so short-term government paper is actually a good thing to own because government will definitely pay you on a treasury bill. But when interest rates go up, the yield on the treasury bills that you're rolled into when the government pays you back on your old short-term paper, they go up too. So you're protected from inflation by the fact that short-term interest rates will rise during an inflationary period. And you are threatened in that same period by owning long-term bonds because they don't roll over. You just are stuck with them if you buy a 10-year or a 20-year or a 30-year bond. And that makes them really volatile in relation to interest rates. So if interest rates go up because inflation's going up, then the value of your bond portfolio goes down. So yeah, you don't want to own bonds. What you want to do is swap financial assets like that into real assets, like commodities, like gold and silver and oil and uranium and copper, because they will tend to do well in a currency crisis because governments can't just make more gold or silver out of thin air. They can't. They can't print gold, they can't print silver as they can with their currencies. So in currency terms, precious metals and the other commodities are going to do really well. And we're just at the early stage of that bull market. I think we've got another 5 to 10 years for that to run.
Okay, so curious in your thoughts here. So obviously this short-term price action with the metals, I don't think people should give a lot of weight to. But the markets do react to things. So one, the market reacted to a hawkish Fed, and I believe gold and silver came under some pressure when inflation started ticking up again after the war in Iran. And, the interesting thing is that, you want to avoid having real negative interest rates on your assets, where the interest you're getting is lower than the inflation rate. And so just curious in your thoughts on these kind of short-term reactions to the price action. Do you give it any weight at all? Do you even pay any mind to it? Some people just don't even, they just ignore it. Just curious in how you navigate that.
Well, yeah, it's hard to ignore big moves in assets that you own, but you should. Yeah, the best way to approach the commodities market, for instance, right now is just to add gradually to really high quality names. If you have a certain number of stocks that you think are good in the commodity space, just buy a little bit every month. Do what's called dollar cost averaging, or use lowball bids. Put a ridiculously low price in. When you're bidding for one of these stocks and see if it drops by 20 or 30 or 40% so that you get them cheaply that way. But don't stress over squiggles because you look at any bull market, And within that bull market, there are brutal corrections where it shakes out all the weak hands and everybody who's in it has a year in which they lost money and they feel stupid and everything. Just, don't play that game. Keep, for instance, long-term goals of, or long-term predictions of, say, $10,000 or $15,000 an ounce for gold, a couple of $100 an ounce for silver, and commensurately high prices for other commodities. And just let that guide you. As long as we're not there yet, then you want to continuously add to your positions. And that makes it a lot easier to sleep, because otherwise it'll drive you crazy. Any market is very volatile, especially when it's doing well, and commodities are no exception. So if your self-image is tied to whatever the copper price is, or uranium or gold, it'll just drive you crazy. So try your best not to pay attention to what the price is and what the action is on any given day in any given part of the commodities complex. Just gradually keep adding, and eventually you'll have a nice portfolio of this stuff at favorable prices, and you'll end up being a really successful investor. Riding long-term bull markets without being shaken out is basically how you do it. And this is our chance in the commodity space to have one of those decades that every investor dreams about.
Okay. Yeah. Thanks for sharing that. So curious in your thoughts on how you're approaching the market currently. Some people don't have any physical gold. So, obviously if they're just getting into that, for me, myself, I would advocate that they start buying some physical gold. But then, the miners have sold off significantly too. And I imagine that people that have been accumulating physical gold for a long time are more interested in accumulating the miners at this particular levels. With their all-in sustaining costs still being low and the metals prices still being elevated, and they're getting some really good margins and cash flows from that. So curious into your thoughts and how you're approaching this market currently. Are you buying physical gold? Are you mostly focused on the miners? Are you doing the blend? Just curious in your thoughts.
Well, I think if you're just now getting into this space, you want to start with the least risky assets and then work your way up to the riskier things over time. So start with gold and silver physical. Buy some coins, buy some small bars, store them in a very safe place, and then when you feel like you have enough real money as the bedrock of your financial life, then move on to the equities that deal in these things, and start with high quality there too. Pick the really good names in the different parts of the commodities complex. The high quality gold miners and royalty companies, and the high quality copper miners and uranium miners, and add a little bit of them too. And once you feel like you've got enough of them, work your way down, get some mid-tier equities, and then eventually, if the market gives you enough time, you'll be buying the junior miners and the explorers, because they're the ones that are most risky but have the most upside. At a certain point, once you educate yourself by buying the high quality names and watching them for a while, then you're ready to look for 10 baggers. And there are quite a few of those potentially in the commodity space right now. So, make sure you don't mess with those things, the lottery ticket stocks, until you're very well versed in what separates a good one from a bad one in that part of the space. So start with quality, work your way down.
Okay. Do you have a particular approach when you're getting into the more risky side? Are you only doing a certain percentage of your portfolio towards like explorers or some of these other risky names that could give you multi-baggers?
Yeah, you don't want, for instance, explorers to be the bulk of your portfolio because they're too risky. Nobody is able to say with certainty whether one of them is going to go up 1,000% from here, or rather than going down to zero. That's what happens with a lot of explorers. As your friend Rick Rule likes to say, all the capital that's created in the the junior mining space is created by 5% of those guys. The rest of them have negative cash flow and end up with negative returns going forward. So you want to be careful with explorers, even though some of them are 10 baggers, and you don't want to mess with them until you're pretty well versed in how the industry works. You want to be able to read a drill report, for instance, and understand what it means, and look at a financing and understand whether it's favorable or not, and look at the people running the company and being able to, you want to be able to judge them based on what they've done in the past. So once you can do all those things, then it's time to buy some juniors and buy some explorers. But you never want them to be the bulk of your portfolio just because they're too risky. And, leave that to the experts, the guys who've been doing it for 30 or 40 years and have plenty of money elsewhere.
Yeah, for sure. So I was actually talking with Brent Cook recently, well-known geologist in the space. And it was kind of interesting with some of his approach where he had a good chunk of his money in T-bills, but then the rest of his money was in the explorer companies. And, as a geologist, you can read drill results and understand what is a good deposit, what is a good project and things of that nature. And so he's willing to, explore more of that alpha there. And he was kind of talking about he's pretty much investing in these companies for eventually a takeover or acquisition or whatnot, where you find a really good project with really good deposits and things of that nature, and then eventually they get bought out by a larger company or whatnot. Is that kind of like the name of the game, or do you think there's or do you have a different approach with that?
Well, no, that's a professional's approach. Somebody who can call up the CEO of a miner and then grill them for 20 minutes and then come away with a good idea of what those guys are doing. And that's 0.1% of the population who has that kind of a background and that kind of experience. So for the rest of us, you want to be a lot more careful because you just don't know, and you don't know what you don't know. That's the problem with any kind of a new field that is in any way technical. So you need to be very careful with the kinds of stocks that we're talking about when we're looking at explorers and even junior miners. So, one solution to that is to watch what some of the really strong players in the space are doing and then emulate them. So you aren't necessarily understanding what you're doing. You're placing a bet on that person, on that expert. And that can work because in a lot of cases, the experts do just fine. So you can do that, but you won't know why you succeeded with any of these little companies. And it's probably going to be really stressful because stuff is going to happen that you just flat out don't understand. And that's not, in general, the best way to approach investing. You should be in a place where you understand what's happening. And you know why it's happening, and you know how dangerous it is. So, if you want to look at the buy list of one of the handful of people in the space who are experts and who have decades of success, reasonable, but you're then kind of buying a managed mutual fund, right? You're buying something, and in effect, you're giving your money to someone else to manage your money for you. And that's an okay thing to do too. It's okay to trust an expert with your money as long as the expert turns out to be trustworthy. But if you want to do it yourself, you kind of have to understand what you're doing to have a reasonable chance of success.
Mm-hmm. Yeah, for sure. Okay, so John, what metals are you most bullish on right now?
Well, gold and silver, like you said, they had a nice correction now. So there's a decent chance that they resume their bull market sometime in the not too distant future, if not right now. And so they look great. Silver is cheaper than gold based on the gold silver ratio. So if you're just going to buy one physical, I would say overweight silver right now. And then a lot of the miners had very serious corrections, 30 or 40 or 50% in some cases. So there's some very high quality, cheap names out there now. And so this would be a good time to start a dollar cost averaging program in the gold and silver miners. And then copper's story is just great. I mean, if AI is going to become what it's going to become, or what people think it's going to become, and electric cars turn out to be most of the cars that are on the road, then we're going to need way more copper than we have, which makes copper miners with working mines right now very valuable, and their stocks are great. And same thing with uranium. You know, a lot of the things that we're planning to do as a civilization are going to require a lot more uranium for nuclear power plants than is now being produced by the world's mines. So those mines are valuable. So that's a list of commodities that are probably going to do really well in the future. And then there's a lot more that I really don't know that much about, you know, rare earths and a lot of things that fall in the strategic metals category that are also going to do great. The U.S. government looks like they're getting ready to put price floors under a lot of these things, which would really change the dynamics of that kind of a market, because usually the big risk is that the price falls out of bed one day and then all of a sudden your mine's not valuable anymore. It's not profitable. But if the government is going to name the price at which they're willing to buy unlimited amounts, and you've got a mine that's producing at a lower price, then you're kind of a risk-free asset at that point. So that I think there are careers that are going to be made in the commodities space, figuring out how that dynamic plays out and how it applies to the various miners out there. But I think just in general, the whole complex is going to do really well.
Are you following the platinum group metals at all?
Not really actively, but I have a sense of platinum being a very useful metal in the auto industry right now, and it's done really well lately, physical platinum. But I'm not sure what I would say. For instance, the rise of electric cars mean for platinum and palladium, and that's an interesting question that I don't know the answer to right now. And other than that, nah, I'm mostly in the big commodities that we just talked about.
Yeah. I just remember this back during COVID times when the rhodium was at, I think it was over $25,000 an ounce or something. It was something crazy, and I was like, what is this metal even for, right? And so, yeah.
I think if you're a 25-year-old smart guy and you're thinking of a career, those things like rhodium and the 15 or 20 other things that are in that category that nobody's ever paid attention to, but suddenly they're hot. I think if you wanted to build a career by understanding those things and by allocating capital, effectively as their stories play out, you could make a lot of money over the next 10 or 20 years, because a lot of those things are going to be very hot. And right now, hardly anybody knows which one and how it's going to play out. So, if you want to be one of those guys, you would have a really exciting few decades.
Yeah, for sure. So your thoughts on, I know we talked about the economy and such, and we talked about a currency crisis. I'm curious in your thoughts on the metals if we get some type of event where there's a recession or anything of that nature, depression, whatever. It seems like these industrial metals like copper, silver, some argue silver is more industrial in nature. Like these may come under some pressure in that type of situation. So any thoughts you have there?
Well, yeah, here's a scenario that it could be very possible in the not too distant future, is that, some tech stocks peak and then tank, as tech stocks tend to do. And that pulls the overall stock market down. And that gets everybody panicked about maybe a falling stock market leads to a recession. And then what's going to happen? In other words, a garden variety equities bear market and a garden varieties recession. Those things happen all the time. And it's, I'd say we're grossly overdue for that kind of thing going forward. So if that happens, historically, it tends to pull down gold and silver and the other commodities. So that happened in 2008. It happened in 2020. And it was brutal for a short time for gold and silver and the other commodities. And that's a very possible thing. That could totally happen, and that could cost you 50% or 60% of a commodities portfolio in the short run. But what happened in both of the times that happened recently, previously, and the times that happened before, is that the Fed steps in aggressively to stop the recession from turning into a depression. So we get massively easy money. That would be the excuse for the Fed to cut interest rates back to zero again, and then ramp up QE, and then maybe even start buying equities this time around. So that would be really good for gold and silver and the other commodities. And it's highly likely that that's the way the Fed will respond to any kind of real turmoil in the stock market and any kind of negative stretch in the economy. So the question is, do you get out of commodities in anticipation of something like that? Or do you, like we talked about, just don't sweat the squiggles and just ride it out? Because if you're doing dollar cost averaging, for instance, that means you're putting the same amount of money each month in a list of commodity stocks, let's say. And the price of those stocks go down. Well, that's bad for what you own, but it's good for what you intend to buy in coming months, right? Because you get a better deal on those stocks. The same amount of dollars buys you more shares. So if you look at it from that point of view, then, okay, there's a correction in the stock market, and that leads to a correction in commodities. So be it. You keep on buying because you know that the long-term prize in terms of higher commodity prices is still out there, and it's going to happen. And now you've got the Fed on your side engineering a new bull market in commodities. So yeah, we could definitely have a disruption in the financial system that leads to commodities dropping. But it would probably be a V bottom where they tank and then they spike. And trading in and out of that would be really hard. So I would say don't try. Do not try to trade this market, despite the fact that there are some big risks out there in the short and intermediate terms. Just steadily acquire, and then otherwise don't pay a lot of attention to this stuff. So and that's psychologically a lot healthier, and really financially too, because you are not going to be able to successfully catch the top and the bottom of this kind of a market.
Yeah, it reminds me of a couple of things. One thing Rick told me is that he looked at a study of a big financial institution, and the top performing portfolios were of dead people who didn't who didn't make any moves or make any trades and things of that nature, which is very, very interesting. And then also, I think in relation to what you just shared, I'm recalling. Watching the Dave Ramsey interview where a couple had called in and they had a lot of silver. They bought silver at the previous top in 2011. And Dave Ramsey, encouraged them to sell all the silver because they were down on their investment. They needed the capital and so on and so forth. And, they bought in at over $40 or whatnot. But, thinking of it now, it's like, yeah, they would have doubled the money, more than doubled the money if they would have kept it and didn't pay attention to it, and so it's definitely some sound advice for people to have a long-term view and to not watch their portfolios every 5 seconds.
Yeah, as long as you're buying the correct stuff. If you've got really high quality assets that are going to get more valuable with time, it makes no sense to pay attention to them. Go away, hang out at the beach, play golf, come back 20 years later and see how they did. Count your new money.
Yep, exactly. Well, appreciate you for coming on the show, John. Plug the audience where they can find your Substack and some of your publications. Okay,
I'm at rubino.substack.com, and I have a newsletter there that looks for actionable advice for the stuff we talked about. And it turns out, a lot is coming our way, and there is a lot of actionable advice for exploiting it.
Okay, sounds good. Well, you all have the information. Thank you all for watching. Please subscribe if you haven't subscribed yet. Love to have your support. And John, thank you for your time.
Thanks, Darrell. Take care.